I posted about couch potato investing on LinkedIn last week. It's simple. Own a stock index, own a bond index, rebalance once a year, and do nothing else. However, I did get some backlash. One of the comments said, and I quote, a good start to settle for average performance, but it won't give you much at retirement. He said you should transition to picking individual stocks to outperform the index. He's not wrong though. Stock picking can outperform. But the data on whether it does outperform and consistently or not for regular people is brutal. Let's break this down. Let me explain what couch potato investing actually is. It is one of the most underrated frameworks in investing. The system is simple. Own a broad stock index, own a bond index, and rebalance once a year. Do nothing else the rest of the year. Hence the couch potato. That's the entire strategy. And here's what most people misunderstand about it. The allocation of bonds in that portfolio is not to make you rich. It's there to stop you from making bad decisions. For example, when stocks crash 30%, your bond allocation will tend to hold value or go up. That will help cushion and stop you from panic selling. And as we covered in the previous video, not panic selling is one of the biggest determinants of your long-term returns. And historically, mixed portfolios often outperform all equity portfolios on a risk-adjusted basis. Just remember, a portfolio you abandon during a crash has a 0% return. So don't. Now the comment. He argued that index investing settles for average performance and that you should invest in individual stocks to do better. I want to be fair to this argument because it's not wrong. Individual stocks can definitely outperform the index. If you bought Apple in 2003 or Nvidia in 2019, you crushed the market, for sure. I'm not debating that. The question is not whether stock picking can work. Obviously, it does. The question is whether it works consistently at scale and for people who are not full-time investors. And the answer is, based on decades of research, is no. Now let's get into the data. Let me give you the numbers. Over a 15-year period, approximately 90% of actively managed funds, those funds trying to outperform a given index, for example, the S&P 500, they tend to underperform their benchmark index after the fees are paid. These are professional fund managers, the likes of people on Wall Street. Teams of analysts, decades of experience, Bloomberg terminals, millions of funding behind them, and 9 times out of 10, they can't beat a simple index fund. If the professionals can't do it consistently, the odds that a retail investor with a full-time job or university coursework, like me or yourself probably, the likelihood is even lower. But here's where it gets interesting from a behavioral economics perspective. Despite this data, most people believe that they're not part of that 90% who underperform, and they're part of that 10% who outperform. This is called the overconfidence bias. Studies show that approximately 74% of fund managers believe their performance is above average. Obviously, mathematically, that's impossible. But psychologically, though, it's completely predictable and possible. There's something else I want to mention, the survivorship bias. When someone tells you stock picking works, for example, the person in the comment, they're usually pointing to their winners, obviously, and they don't mention all the other stocks that went to zero. So now let me address the specific exchange in the comments. He asked me, is that your experience of stock picking? When I explained the data, he said if you had a better understanding, you would change your mind. This is a classic pattern though. When someone's beliefs is challenged with data, the response is often to question the credibility of the person presenting the data, me, rather than engaging with the data itself. I'm not saying he's a bad investor. Don't get me wrong. He might generally outperform, but the data says that for the majority of people, the majority of time, stock picking underperforms indexing after fees and taxes. So, who is this framework actually for? Here's the distinction I was trying to make in my reply that I think got lost and the person overlooked. My content is for students and people in their 20s, people with jobs, people studying, people interning, people who have other things going on in their lives and want a system that works in the background. For that audience, couch potato investing is not settling for average. It's beating 90% of professionals with little effort. I want to be clear. Once again, I myself own individual stocks in my own portfolio. Bloom Energy is one of them, and I talked about it on this channel. But the core of my portfolio is index funds, the likes of the S&P 500. And the individual positions I hold are small, calculated bets where I have a specific thesis, not a feeling. I've done a lot of research behind it. It's not just a lucky gamble. If you want to pick stocks, treat it as education money, especially for those of you starting to learn. Learn from it, but do not make it the foundation of your wealth building strategy unless you are prepared to do it as a full-time job. If you're smart, ambitious, and still unsure what to prioritize, this is for you. I'm opening a waitlist for behind the scenes Blueprint Lab where I share the exact systems I used to juggle internships, studies, building, investing, fitness, and social life in my 20s. Tools that start from where you are, not where you should be. Join using the link in the description.